With so many asset classes for investors to choose from, how do investors assess the offerings to build a robust portfolio? And what should investors look for from an asset manager? Andrew McVeigh, Managing Partner at Remara, joins me now. Andrew, thanks so much for coming in.
Thanks, Danny. Thanks for having me.
Okay, so within the context of credit, looking at those products, private credit, what should investors look for in a product?
Yeah, certainly. So I think the credit landscape is a difficult landscape for most investors. It's pretty opaque in terms of what the asset class actually is. I think there's a couple of really key things. So one is diversity in underlying assets and underlying obligor levels. The second is a consistent monthly income. So with private credit assets, you have advantages over bonds in terms of they're usually floating. So you'll get a very consistent income yield and you won't have a lot of capital volatility. So what you want to see is a fund that has a consistent yield month in, month out, and it kind of moves with the RBA. So a lot of people, I think, got stung over the last 18 months with the RBA rate rises. They're in fixed rate style loans or fixed rate style property funds, single asset funds. And as the RBA increased the rates, they weren't able to increase their ultimate yield that they got off of those assets. So I think consistent yield and a floating underlying asset class is really critical for those private credit assets.
How easy is it for investors to obtain that transparency when it comes to the underlying composition of the assets to which the credit's being written?
There's a few avenues. I think research reports are really strong. So there's a number of parties that provide research reports, and our private credit fund has been rated by Foresight Analytics and SQM, and they go through a series of reviews of all of our underlying assets and structures and supporting documentation, credit, IC process. So they can provide a really consistent view of what we invest into versus a number of other credit funds that they essentially rate as well. And the second component to that is essentially then the management reports or the monthly report that goes out to most investors. So we'll provide a lot of information about our portfolio, the underlying obligor, the number of contracts that we have within it, and that way you can actually then get a good understanding about the diversity of the credit and the strength of the underlying credit in that portfolio.
Absolutely, and of course private credit has taken off hugely in the
Yes.
last 12 months or so, I know, because I've been discussing it a lot. So in terms of what's the role that a credit fund plays within one's total asset allocation? How does it fit in versus traditional equities and the yield that you pick up on our lovely frank dividends that Aussies love, versus, let's say, corporate bonds, which have also become more available to investors?
Yeah, certainly. Look, that's an excellent question. I think as you move through the asset classes, obviously equities suffer a lot of volatility in the capital value. So any one day you can open your portfolio and you're up 5%, down 5%. So that provides a lot of stress to most investors, particularly if you're in a self-managed super fund or you're investing more towards the final income stage of your wealth creation. So private credit can help smooth out a lot of the volatility that you see within the equities investment. And in terms of yields, you can generally get some pickups in terms of yield income versus traditional dividends, even with the frank nature of distributions that come out of most ASX businesses. And that's kind of where private credit can assist in that type of comparison to traditional equities. Versus real estate. Real estate's obviously had a massive boom. It's come off over the last 18 months with the rate rises. It's probably hit a point of stabilisation. And where private credit can provide an alternative is, again, limited volatility in your absolute capital value, but what you do get off the back of that is a really strong income return and income yield. So our private credit fund is returning around about 13.6% at the moment as a running average, and that's been consistent month in, month out, over the last 18 months of us essentially establishing that fund. And that's where you really get the strength. You get a return profile that's slightly higher than what you would with traditional equities, and certainly what you'd receive through traditional rental incomes and things like that. But what you don't get is the volatility in your ultimate capital value, and it allows you to rest a little bit easier at night knowing that your portfolio has a bit of a foundation where you get very good strong income yield and you don't have a lot of capital volatility.
Okay, I'm going to put on my cynic's hat and say yes, of course, but a 13% yield, well, that's absolutely delicious. I'd love that. But what are the risks of the underlying assets? Because we are in a stage in the cycle where interest rates have gone up so much, and
Very good question. Yes.
You know the whole
Yes.
thing, the most since the early 1980s.
Yep.
And in the property sector, we have seen a lot of developers,
Yep.
even big ones, going into administration.
Yes.
So it's ultimately really important, is it not, for the manager to be very careful about what type of credit they're moving into?
Yeah, look, that's a very, very valid point, and it's extremely important for the investor to understand the underlying portfolio. So for our private credit fund, we've got 6,500 underlying contracts. Across our platform, we've got 12,500 underlying contracts. So we've got 4 businesses that originate 9 different types of credit assets. So as I mentioned before, a really key aspect to investing into private credit is diversification of the underlying contracts, not just in terms of obligor, but state-based postcodes, industries, and obviously asset types as well. So whether it be a construction loan, a land loan, an SME business loan, a trade and invoice facility, something like that. So our fund actually has a substantial amount of diversity across 9 different contract types, 6,500 underlying contracts, and that provides us the strength that for us, we've seen a little bit of stress on the real estate side, but that's 20% of our book. When we then counter that with Australian SMEs, we've seen a very resilient SME market in the Australian economy. There has been an excess of liquidity, and they've been able to buffer the interest rate rises. And what you tend to find, particularly with the SME market, is they generally work in their business, so they're a lot more incentivized to keep that business operating, meet their obligations to ensure that they can put food on the table for their families.
Absolutely. So what size is the fund?
So the fund at the moment is about 12.5 million. It's part of a strategy that's 850 million. Most of our funding at the moment has come from institutional investors that have their own vehicles and own structures. The fund over the last 18 months has been opened up to wholesale investors, and we're in the process of opening up to retail investors.
And how would you facilitate that in terms of the access for the retail investor?
Yeah, so we've got our website. You can log onto our website and go straight into our investor portal. We provide monthly communication with everybody. We're also in the process of getting onto the investment platforms like NetWealth and Premium.
Oh, fantastic. And just in terms of liquidity, how the lock-up periods for investors?
Yes. Very good question. 3 months, so rolling 3-month liquidity. And essentially at the end of every second month, you put your request in, and at the end of the quarter, you get paid your request for redemption.
Oh, cool. And just one last question,
Yes.
Andrew. The 13% return, monthly, annualised, I assume.
That's an annualised return,
yes,
not monthly.
Yeah, exactly. That's post-costs.
That is post-fees, yes.
Yeah, post-fees.
So we've got nominal management fees of 50 basis points, and that essentially allows us to kind of keep the platform licensing running. And then obviously, as I said, we invest into a lot of our underlying assets, and we've got 4 platforms. So we are very aligned with investors in terms of that credit. And I think a really critical part for us is we invest underneath all of our investors across every loan in our portfolio. So we ultimately, as managers, will lose our money before our investors lose their money.
Oh, well, that sounds probably like something sweet to the ears of
That's why I
potential
left it to the end.
investors. Exactly. Andrew, thanks so much for joining The Wealthy Effect.
No worries. Thanks, Danny.